check, check. All right, can somebody tell me if they're getting sound? Audio check. All right, it's coming through. All right, group's going to thin out here because we're moving along. We're going to see who's committed. We're going to see who's getting past the, oh, if I can't trade it today, I guess it's not soon enough for me. We're going to see who's committed to their trading. Because they keep coming back, they keep coming back, they keep coming back, they keep coming back for more. Going to see who has heart, going to see who has soul, going to see who's committed to their future, how important their dream is. Too many people ready to give up on their dreams. They give up on themselves. Their ego talks them out of their dream. So we shall see. We shall see who's got the commitment. All right. All right. Good morning, good evening, good afternoon around the world, no matter where you are. I'm here to teach you about scans, forks, and fibos, and we're just getting started, my friends. We're going to move right through. We're going to get going on forks. We're going to get real brave on scans. We're going to do a Fibo stuff. All right, Tasha, you're going to need to catch up on the course itself. Yeah, because, they kind of go hand in hand. All right, for you first time guys, I'm going to put up a screen. I want you to take a screenshot so you'll catch up on a lot of the information. So, yeah, there is somebody tell them to refresh their screen. There is sound. There we go. Thanks, Tim. Well, thank you, thank you, thank you. Okay, we got some pitchfork virgins in here. That's cool. Which reminds me of a joke I heard over the weekend. Are you ready? Ba-dum-bump. What do you call a nun with a cell phone? What do you call a nun with a cell phone? The answer is Virgin Mobile. It's so third grade, but I laughed at it. Alrighty then. So take a screenshot of this, please, if you haven't already. It's coming down. We're moving on. Got a lot to cover tonight. Speak up as possible. I'm getting close to about 50% on the mic. Is the volume not okay? Yeah, I got a lot of good ones for you guys as we move through. Okay. It hurts you a little. That's funny. Somebody saying need more volume. All right, let's move on. All right, real quickly, I'm going to run through this, and your screens will catch up, and I guess the audio will catch up. But let's remember, I'm an educator in here, so I'm not an investment advisor. So you have to be careful the kinds of questions you ask me, and I have to be careful about the kind of things I tell you. right? And where's that screen? So I'm not going to tell you, don't send me a fork saying, should I enter here? Don't draw a fork out and say, should I enter here? We're going to cover the basics, and you're going to have to grow up a little. You're going to see what we do as the weeks go on here. So we'll be at that point where we're posting forks, and we'll go back in time and look and see what they generated, and we'll see how many of you are getting trades off of that. All right. So my goal is to educate you on many trading options, illustrate the pros and cons, but ultimately you as a trader are going to make the choices of parameters and the techniques for entry. Blah 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 blah. The rest of it's there, and you watching today have an obligation to read that. So I would read it before you go farther. All right, let's move on. We talked about trade calc. Trade calc, fxtraderscalculator.com. We showed you how to calculate proper risk in a trade. So I want the people in my group, when they start trading live, even in demo trades, I don't want to hear what you have into a trade based on number of lots or lot size. That's not relevant. That's only specific to the account size itself. So somebody saying they got one lot, 0.1, 0.5 doesn't mean anything. So it's not proper terminology to talk about lots in a trade. It was on the first page that I told you to take a screenshot of. I'll put it up at the end. It's at the very bottom, fxtraderscalculator.com. So we talked about trade calc for position sizing. We validated that trade calc does it correctly. So what you need to do is use trade calc for position sizing. All right, anything here I want to review that's important on this next slide real quickly? We've talked about correct structure but wrong. We've talked about incorrect structure but right. Don't mix the paradigms. A lot of you are trying to do that. We'll talk about how you're doing that with your mindset here in a few minutes. I'll take pips over purity any day. We talked about trying to find the overall trend on your time period and find a channel and try and draw your forks in conjunction with that channel. You should be drawing forks on your current swing low or swing high unless it's not feasible or possible. Okay, so we've gotten past most of that. All right, so this is on my list for today. I mentioned it previously, but I'm going to get a little advanced with you and cover it. And where is that list? Oh, there it is. Class notes for today. All right, so I want to talk about this area right in here. Which is common trading sense The upward fork buy bottoms, the downward fork sell tops. Otherwise, you are growing your stops on retests. So I don't want to lose anybody, and I don't want you to think you need certain skills just yet beyond what I'm teaching you. But I want to talk a little bit about Elliott Wave for just 5 minutes. And again, I'm not trying to teach you Elliott Wave, I just want to make you aware of something. So a normal Elliott Wave structure, we go from a bottom of something in the move up, if I'm diagramming the move up, and what we're going to do is go up to a wave 1. The wave 2 is usually quick and deep, and I can tell you a little bit more about that in a second. We then project off to wave 3, and then we have a slow, elongated wave 4 going to 5. Now that is the most common structure on the impulsive side of an Elliott wave. You go, what's an Elliott wave? So that would be a structure. Now, what that means is every time you bottom out, there's going to be a 1, 2, 3, 4, 5 structure out of it. It doesn't matter for those that are advanced. It doesn't matter whether it's an impulsive or a corrective side. For those that are advanced, you know the corrective side is typically an ABC if it's a simple correction, and the ABC is very similar to the 1, 2, 3 in that the 1 and the A are 5-wave moves. The 1 to 2 is a ABC, and the 2 to 3 typically again a 5-wave move. So what that means is at your time period, the first thing that's going to happen from a fork hit is we're going to go up to a 1, come back down to a 2. Now, eSignal, a big company in the financial market industry, did a 10-year study on Elliott Wave and all financial markets. And what they said was this, that for a wave 2, 73% of the time, it's going to terminate, make that an easier 3 to read, it's going to terminate between 50 and 61.8. In order to be considered a wave 2, it has to pull back at least 20. A wave 2 cannot go down below the start of X. If the wave 2 goes below the start of X, we have a failed wave. And our thinking about this being an upward impulsive move is incorrect. What's really happening if we have a failed 1 or a failed 2 is that price is continuing to come down. It just had a little bit of a retreat or retracement here, and now it's going to come back down lower. So this reality of where the wave 2 turns around, and I really, my bad for overlapping stuff here. Let me get this right for those of you that want to take a screenshot in a minute. That should be yellow. Now don't let this get over your head. I'm going to explain this in terms of what we're doing with our pitchforks in just a second. 50 to 61.8. I'll make it tighter. So 50 to 61.8. 73% of the time, that's a lot of turnaround in that zone. So here's the problem with a lot of traders. I'm going to draw that same wave X12 over on the right, a little bigger. So we come up to 1, we go back to 2, and again remember, 73% of the time, at least 50% down to 61.8. So here's the mistake a lot of traders make when they have a hard hit and it's a real reversal. They'll get in the trade, they'll ride it up towards 1, and then it starts to reverse on them, pull back on them, and somewhere about here, is where 50% of the traders exit. Well, if the wave has to pull back to 50% to 61.8, 73% of the time in order for this entire move to continue on, taking yourself out here is taking you out of the trade. Taking yourself out on a little bit of pullback. Taking yourself out on a little bit of more pullback, on a little bit of more pullback. What has to happen is you have to hang in there and let this thing come down to that zone before it can continue on. No guts, no glory, baby. But if the wave 2 goes beyond the 100% of X to 1, we no longer have an Elliott wave, and price is actually continuing in the original direction of the move down. Alright, so this is a little bit advanced for some of you. That's okay. Yeah, a couple thousand times, Michael. But this little bit of knowledge about wave 1, 2 is going to make a whole lot of sense to you in your initial trades. Okay, now remember, initial trades are doing nothing but demo. Nothing but demo. Anybody comes in here talking about a live trade, they're booted from the group. Okay. Not going to demo. We're not going to live trade this yet. And I wouldn't recommend you talk about live trades until you've got several demo trades that you've posted and we validated for you. That was the right place to get in. I don't care whether they work out or not. We'll talk about that later. I just need the structure and your entry and the money management to be sound. The rest will become robotic. Alright, so a little, like maybe overkill on Elliott Wave, but I want you to understand this one too. Now here's why it's significant. Remember, this whole thing came about because I'm trying to talk a little bit about setting up to win. And that meant upward forks, buy bottoms, downward forks, sell tops. Let's see if this makes sense. We have an upward pointing fork. I'm exaggerating it to make the angle pretty steep so you see what's going on. Which means if I have an upward pointing fork, swing high, swing low for my fork structure. At a swing low, we don't expect price to come lower. We expect price to go higher, so a swing high, swing low is pointing up. On a traditional fork, we come back and hit that swing low. Swing high, swing low, swing low. Pointing upward. So, what are we better here to do? Buys or sells in this upward fork? What are we better off doing? Buys. Now see, you're going to find out not only does that make common sense, but let's talk about this from an Elliott Wave perspective. Woo woo. So price takes off, hits the median, comes down, and we're having a hard hit. So at that hard hit, whether it's a correction up or an impulsive move up, we're going to need to see a 1-2 move usually. Which means what? Price moves up. It's a deep and quick pullback. 73% of the time, 50 to 61.8. Notice how this conforms to our fork. Draw this a little thinner. So price moves up. It wants to do a two-wave bingo. Look at the retracement. 50, 61.8. Now, if I have my stop loss, well, my manual stop loss, set outside my fork per the chart we went over last week, and we'll review it more. From a technical standpoint, here was my stop loss when I entered. Here's my stop loss on the wave 2 check. Notice I've gained pips at the wave 2 checkpoint. So if I got in the trade at the first hit on the fork, by the time it retests it at 2, that really is a wave 2 terminating, which means you can expect what? An impulsive move out of here. So notice a retest here is most likely a wave 2, and then price goes on. Not always going to see it so clearly like this. But let's look at it from the opposite side. Let's say you're looking at price having gone up, it crashes the fork, gaps the fork, comes back, does a nice test to validate the fork, and it comes up here and it's bouncing off the top. Well, once again, I got my stop loss in there. And what that means is, at the point of entry, there's my stop loss. Price decides to pull back and retest. Well, now we're in a world of crap. Now we're in a world of crap. Because why? Well, if this really was a hit and we're coming out impulsively, this would be our wave 1. But what's wrong with our wave 2? It goes below the X, or the start of the wave 1. There would be the start of the wave 1. Well, a little lower than that. It pulls back. It now crashes below the start of wave 1, which means our Elliott wave structure is off. This is probably not a trade I want to take because this is going to do what I call creep or slide. We're probably going to have a bunch of retests. This really means there's still upward force and it's just sliding on up to move on up. So the whole structure of Elliott wave favors the buy on a retest, whereas on the top, a retest, not only are you negative now because your stop loss at the retest is higher, which means your stop loss now is in a negative position compared to where you started the trade. Yeah, you guys are going to learn that these broadcasts and the transmission and reception are heavy bandwidth. And so if you've got things going on your computer, like you got Facebook running and you've got some mail apps open, and those apps Facebook and those other apps tend to swell. Before you start this session, you should close down all apps if you're on a computer. Just shut them down. They're going to clog your memory. It's going to affect the bandwidth. So unless you have some really strong indications that really is the top, it's probably not a trade you want to take, which is why you want to look for the bottoms. So the only way I will take a trade at the top is if there's an energy point. Tim's saying that right now. I.e. there's a natural Fibo there, or in this case, maybe there is a fork Fibo. You know, a fork Fibo is an extended retracement of this move. It comes up, it crosses the 100% line, so now anything above this is over 100. You know, There it is, 100%. And oh, look at that, 161.8 right there. Boom. I'd take that trade. I really don't want to take these trades because even, in order to go in my favor, you can't have a retest because the retest in itself, because of the slope, says that next retest is going to be a wave 2 that goes beyond the X line or the start of my wave 1, which means it's not a valid move. There is not a reversal at this point. Price is valid. Price is still wanting to validate itself going higher. So if that's all too complicated for you, retreat back to this on upward forks by bottoms. Unless you have an energy point at the top. Now the same is going to go true, but in the opposite direction. I have a fork like this. My wave 1, 2 is favored this way. Wave 1, wave 2. Notice wave 2 is below wave 1. Here's my X. Here's the start of my wave 1. Here's my wave 1. This is wave 2. And look at the looky. There it is in that 50, 61.8 zone. 50, 61.8. Which makes what? A great second entry. So this is just a little bit about market structure. We'll get a lot better at this as time moves on. No, I'm not going to say any particular number because it could be any Fibo. And of course the opposite here is true. A buy on a downward fork, we run into the same problem on a retest. The wave 2 is now driven below the X, and therefore it's no longer a wave 2. This was never a 1. The chances of this going up impulsively right now are pretty slim, and this thing is probably going to slide down some like it likes to do on these bottoms and extend this out. And if you're trying to enter these, you're going to be like -3, -3, -3. You can come crying back to me and Tim and Zoe and Steven and Adam and Theo, and you're going to be like, I don't know about these forks, they don't work. So whether you understand the whole thing about Elliott Wave or not, that's more for intermediate to advanced traders. Don't worry about it. Just understand you're going to be much better off in your initial demo trades to buy bottoms and to sell tops. Any questions? Steve, where's the 4-step rule? That's okay for beginners. We're doing forks. We're doing forks and scans. We're going to get past all that. There are some good 3 and 4-step systems, but you still have to have some baseline knowledge. Right? You're going to have to know other things in those systems. So, sorry to burst your bubble. There ain't no easy pickings. If it was easy pickings, everybody would be doing it. And once you're starting to make consistent profits with your trading, and somebody hears that you're a trader, and they go, oh, I heard not many people do well with that. You go, that's right, most don't. But I do. So you'll have some pride in your accomplishment. Hey, Tim, you want to take care of Lin Tonk for me? Oh, Linton. Okay. So, we're going to, as we move forward, we're going to get more into Fibos, and we're going to cover the full spectrum of Fibos. Retracements, extended retracements, projections, expansions. But we're one thing at a time. Creep, crawl, walk, run. As far as Fibo levels, we'll give you a couple simple ones at the end. Nope, I'm not going to go back and show you how to draw a fork. It's in the training course. Sorry, not trying to be rude, but the people that have been here 6 weeks now already know because they've been through the pitchfork training course. So you got to go through the pitchfork training course. You'll learn how to draw forks. Once again, it was a slide that was posted at the beginning of the session. You guys are going to also have to learn how to be punctual. 9 p.m. is not, oh, gee, I better go sign on to my computer. That's called 8:50. Set your timer to be there on time. Sorry, guys, don't have a lot of tolerance for lack of punctuality. I was in the military, and sometimes 5 seconds means the difference between life and death. When you call in an airstrike and you're the pilot, the last thing you want to do is be taking out your own guys because they were 30 seconds late. So punctuality is very important to me. All right, blah, blah, blah. We've gone over most of this. All right, let's move on. So there's the chart for stop losses. We'll come back to that in a minute. Let me go back through some new things that fall on top of that chart that we learned last week. Yeah, exactly. 5, 4, 3, 2, 1, boom. Hey, look, when Trump finally gives the signal to drop that bomb on Korea's little dictator tot, they're going to want to have the timing right. So, up channel, buy, bottoms, down channel. Yeah, that's what he is. He's a dictator tot. So, down channels, sell the tops. All right, so now we're talking about this is the progression of entering a pitchfork trade. You want to kind of do a self-check and make sure what kind of trade you're entering. Remember, I'm not saying you can't do sells in an up channel. I'm just saying you need to check yourself and make sure you have a real strong reason why you want to do it. And especially if you're talking about a multiple check in short distance, like you get very often on the pound yen. One wick up, hit the fork, pull right back down. Oh, next wick up, hit the fork, pull back down. The trouble is on an angle like that, that next wick, well, it looks like a nice touch. You're getting more and more dangerous, and is that the stop losses progressively have to be getting worse. If you enter and it decides to retest again, you're now negative. And I don't enter a trade to immediately go negative. So unless you have good reason, I'm recommending buys on the bottoms and sells on the tops. If you want to do it differently, as they say, buyer beware. In this case, buyer beware, seller beware. So you want to use trading calc and calculate your position size. Again, the variables to calculate position size is the amount of money in the account, whether it's a standard account, $10 a pip, a mini account, $1 a pip, or a micro account at 10 cents a pip. So you need to know the value of the pip, you need to know your account size, you need to know the risk you want to put into the trade. I saw a guy the other day who was, he was Mr. Hotshot. He was chewing up all the traders. IML sucks, excuse my language. Blah, blah, blah. and someone's talking to him, and he's like, well, I typically put in, zero point 0.5, 1. It's like, dude, I don't care what you're putting in. That doesn't tell us anything. How much risk are you putting in the trade? If you lose that point 0.1, how much of your account are you losing? This is the standard to talk about what you put in the trade. Because what? It disguises intentionally the size account that you're trading. When you talk about lots, that doesn't speak. I mean, when you talk about positioning by lots only, how many lots you have in the trade, it doesn't. Traders have a feeling of, well, he must be better skilled because he's got 2 lots in the trade. He's got 3 lots in the trade. No, he might have, grandma's inheritance. He's got $30,000 in a trading account. And you, through blood, sweat, and tears, have got $500 in your trading account. You both would trade 2%. But talking about lot size just, to me, says you don't understand how the Forex is based. Because it's not about, oh, I've got 0.1, I've got 0.2, I've got 1. It's what are you risking in the trade? That's not what you're risking. What you're risking is a percent of your total account. So we go down here. How much risk are we willing to lose? 4. What is the size of our stop loss? Those 4 elements will tell you, when you put it into trade calc, how many lots you get to trade, depending on the type of account you have. Maybe this is a mini account, and so I'm trading 21 lots. So trade calc will let you put in those 4 variables. It'll do the position sizing for you. We've already validated that in previous sessions. So there's what you would put into the trade. So first of all, up channel or down channel, know what I'm doing. I calculate my position size to determine how many lots I put into the trade. All right. Now, we're going to go back to that previous chart. We're going to go back to that previous chart and look at where the stop losses are going to go. But my entry is actually done on 2 pips of pullback on my bounce. That is live. Now 2 pips doesn't sound like a whole lot, which is why you require precision in your forks. All right. So 2 pips of pullback. You're in the trade. You know how many lots to put in. You've got that set. You're ready to go. You get the bounce you were thinking you're going to get. Boom. Now, one thing I didn't include in here, okay, and this is more for TradingView people, TradingView subscriptions, is, okay, up channel, down channel, I can set alerts. So I can draw a diagonal line, and depending on the width of my fork, there's the top of my fork, I can have an alert on a line, and again, depending on the size of my fork, 5 pips from my fork top, 10 pips from my fork top, 15 pips from my fork top, and all that alert says is come to the charts now, Mr. Trader. I think there might be a trade pending. If you're already got a relationship with the broker and you're using MT4, then that's fine. But we're not doing anything on MT4 with our charts. We're only going to use TradingView, either the web scanner or a subscription to TradingView. I'll warn you about MT4. MT4 is a loose cannon because any broker can use MT4, which means your lower tier brokers will use MT4. And the whole reason, to be careful is because those lower tier brokers can have very poor quality data feeds. Again, you get kind of what you pay for. High-end brokers will have multiple data feeds combined, multiple bank feeds to create a data feed. I remember back in the day, FX Solutions, when they were still around, they had 57 bank feeds in their data feed. It was a blend, but it was the best there was. They were just, any old broker. So I've done, for some high-end systems that I have, we looked at, I took 30 really good MT4 traders and I gave them my system. And at the end of the beta test, 6 weeks later, 29 out of 30 said, I don't want to trade on MT4. And the reason was there were various times, see, MT4 could be hooked up to any broker. We're not going to recommend brokers, but the more mainstream broker you can get, the better the data feed, the less inconsistencies there will be. But in that beta test with 30 MT4 experts, in the beta test that we did, we had pip differences in price as high as 7 pips. We had entries that would gap on some trading stations. Candle closes and it just sits there. Other brokers, you'd see the price move 2, 3, 4 pips. It might take a minute for that other broker to move. It was literally, and then all of a sudden it would move 4 pips at once. So everything I'm going to be doing in here, for the most part, is going to be trading view based. We've got a web analyzer coming out in November as an a la carte item. Guess what? Trading view based. Web scanner, guess what? Trading view based. All right. So you could put an alert on this to say, come get me. And there's certain times where that's practical. If this is a 60-minute fork and I have the yellow line 7 pips away from my pitchfork line and I'm out back with the kids at the pool or whatever, ding ding ding, hey, I get a cell phone alert, SMS alert. Hey, you're within 7 pips of a potential entry. Web scanner went from FXCM because U.S. traders can no longer trade FXCM. They were kicked out of the country. Even though the web feed is still available. So there was a decision, because there's other trading going on using JAFX, to move the web scanner from FXCM to JAFX. Oh, yeah, that was the second step when it went from Trader's Way to JAFX. Yeah. Thank you for reminding me. It was FXCM until FXCM kind of said, yeah, there were some issues there. Let's just skip that. So yeah, it's JFX. So you can set an alert. You don't have to sit here and stare at charts. Okay, now that's only available on Trader's Way. You're not going to be able to set that kind of alert. And not only that, the web scanner, you don't have that much time. If anybody has one of the old MT4 stations that IML had, that had the or still has the 15-minute alerts available, please PM me. So any of you diehard existing traders who have an MT4 platform that has 15-minute alerts on it, let me know. I just said the alert is a line. When I have a, here's my pitchfork one more time. There's my pitchfork. I can set an alert on a diagonal line. So I just merely draw a line on top of the red line and pull it down how many ever pips I want. For a 30-minute chart, 5 pips is generally good enough. Maybe for a 15-minute chart, maybe I want it a little tighter because it moves faster. A little bit more because it moves faster. So you'll get used to that. That's what demo trading is about, to develop your sense of what you like, your rhythms. There's no standardization for when you want the alert. Just know if you miss it and the trade moves more than 2 or 3 pips, you can't enter late. Not with our tight stops. All right. So where am I on time? Yikes. So calculate position size entry on 2 pips pullback. Our MSL and our ESL. So again, remember, we run 2 stop losses. The ESL is the one we used in trade calc to calculate lot positions, and that is we put 2% into, if the table calls for it, a 10 pip stop loss. That gives us our lot size, and that gives us a hard line on the chart. Our MSL is our manual stop loss. So once again, if I'm in this cell at the top of a fork, let's say that's the top of my fork, I have an MSL. MSL is a manual stop loss. That's what's set by the chart. Then I have another stop loss out here. I don't have to draw the line. And as the trade proceeds, I'm constantly moving that stop loss down. So if I do get the bounce and it's going my way, my MSL remains here, but the ESL that I have in the trade station, so this is my ESL, same thing as your trade station stop. You get to move that more and more and more into profit as the trade comes downhill. Okay? Because you're always above the trade. Boom, boom, boom. Now my stop loss is here in my trading station, whereas I started here. Might seem like a lot of work for you. I probably wouldn't advance it every time it moves a pip. But if I have a 3 to 5 pip gain on a shorter term trade, I'd probably move it the extra 3 to 5 pips. It's worth the protection. It's called emergency for a reason. You can do an alert on anything on TradingView. Yes, you can do alerts on diagonal trends. All right, so we talked about the MSL per the table. All right, so here's a trader's choice. And this is going to come down to your risk aversion perspective. So you want to decide on profit taking. And what we're going to do there is one of 2 ways. You're going to stay, option 1, option 2. Option 1 is you're going to stay with 100% of your lots. You're going to move your MSL, ESL forward, and you're going to be profited out with 100% of your lots at your designated MSL. The second methodology would be to leg down. And that just means if I have 4 target prices, I could leg down 1/4 of my units as I move through those 4 targets. You're still going to advance your stop loss. You're still going to profit out at your last stop loss. The difference here is you've taken some profit along the way. So it has a mixed message. Because you're taking some profit along the way, here's my trade entry, and I got my designated profit lines, like just like on the chart, let's say, with a scan. Here's TP1, there's TP2, here's TP3. If I've only got 3, 38, 62, 100. What legging down says is once I cross my 38% line, I could take out 1/3 of my units. Now, I wouldn't do it just because it touched the line. I would wait for some sort of sense of pullback. That then is when you take out your 1/3 lots for crossing your 38% line. Don't take it out just because you tag the 38% line. Wait for there to be some pullback against you. When you get that pullback against you, out comes 1/3. You get past your second target line, you start to get some pullback. Now I'm out my second third. I finally go past my 100, again, wait for some pullback. You very well may get a candle that takes off. So you want to have some pullback. Now my last third comes out. So that's legging down. Both of these, whether I stay in 100% or whether I'm going to leg down, I started with 2% in my account. So if that said I could trade 21 lots, if I stay in 100%, I stay all 21 lots in until I get profited out at my manual stop loss. If I'm going to leg down and I have 3 targets, 21 divided by 3, I'm going to take out 7 lots at each target. It's manual stop loss. Yes, it is mental. It's your first exercise in discipline. If you post a chart and we see price went past your MSL and you stayed in the trade, be prepared to be spanked. You need to be called out on your discipline lapses. It is an MSL. It is a manual stop loss. There's plenty of room on the other side. Don't trail stops. We don't trail stops in the new paradigm. So some of you will want to leg down. Some of you will want to stay in. I've done long studies on this. There are many issues with these strategies. With the legging down, the problem is 1/3's out, 1/3's out. When I finally get up here, I only have 1/3 of my lots that went the full way. So you go, oh, it would have been better to have stayed in with all my lots. Well, what happens when you stay in with all your lots and it turns around after about the 2/3 mark and comes back? Depending on how you have your stop loss, you're going to have a lot of erosion in having all your lots in. But here's the deal. I've studied both of these. I've looked at multiple places of reversals. I've looked at multiple tags on different 3 tags, 4 tags, 5 target, 3, 2. I've run the gamut on it. And the reality is the difference between these two, holding all your lots and legging down along the way, is at max about 3 to 4%. That's the difference, not in total gain, but just the difference between these two. Which means if one yielded 100 total pips when all was said and done, the other might have yielded 96 total pips. I'm not talking about the length of the trade. I'm talking about the pips gained per lot. And so we average out, it's a small difference in percentage between the two. The one that has the higher percentage is staying with 100% of your lots, which just it goes against many people's feelings. Okay. So we talked about you have to make a decision. This has nothing to do with money management. It has nothing to do with where the stops belong. It's just whether you're going to leg down or stay. I just drew it. I mean, you guys need to pay attention. Here is your fork. There's your top line of your fork. You're entering a sell. Price comes up. It pulls back 2 pips. You enter the trade. Your MSL is here per the table in the chart that we went over last week, which we'll review again. At the time of entry, your trade station stop is 10 pips. If the chart says 10 pips for your ESL, it's 10 pips. There is your trade station ESL right there. All we're saying is if price comes back up and breaches our fork, we're going to take ourselves out before it gets to our trade station. We're going to take ourselves out manually at this outer pitchfork line. That outer pitchfork line being the manual stop loss. You have to take yourself out. This is your trading station stop loss, or as we call it, the emergency stop loss. Well, solidifying profit merely means you are break even. You have profit with a stop loss in place. So both these strategies, as soon as you get to break even plus 1, both of them solidify your profit. Watch this video again. I just explained the difference between the two. They both carry risk. They both carry reward. It's a personal choice. I'm telling you through lots of study and analysis, the difference between the two is very minor. So you might as well pick the one you're most comfortable with. Staying in is going to give you much higher profit in trades that go longer. Legging down is going to give you more profit in trades that end up being short, smaller. And if you have the magic window on being able to tell me whether the trade's going to go long or not so long, please send me a link to whatever information you have, because I would like to know that. So there's always trade-offs in trading. There's always trade-offs in selection of a money management system. Just trade the same thing every time, and over a volume of trades, it doesn't matter. Old paradigm mindset is to take a trade and go back and analyze the hell out of it. Solidifying profit is nothing more than guaranteeing that you're, instead of being stopped out, you're profited out. I think I've heard Christopher Derrick even refer to a stop loss when you're in profit as a profit loss, or a stop profit, a stop profit. This is part of the new paradigm. We're taking trades where there are burst moves. The burst move should get us to break even. All right, so here's a little bit more on our tight entries. Most of the time, somewhere between 8 and 10 pips. The smaller the trade, the closer to 8, 15 and 30-minute trades, maybe 8 pips. You can actually move your ESL to break even plus 1. The formal way of doing this would make sense, and again, I don't want to lose some people, but I also want to address the ones that can understand this. The best way to move your stop loss to break even is after your wave 2 is cleared. If I have my X and I go up to 1 and I come down to 2 and the 2 is taking off, I already know the wave 2 is completed, and especially if it's sitting in that conversion, if that retracement ends in the 50 to 61.8 zone, like it will 73% of the time, according to eSignal's 10-year study of all financial markets, if it ends in there and reverses, then I can move my stop loss safely to a break even plus 1. The wave 2 is ended and it's on its way up. And for those that are smart with their Elliott wave, they also know this move to 2 to 3 is also a 5-wave move. 1, 2, 3, 4, 5. So very often you could wait for the clearing of the 2 of the 3. Same concept. But either way, once I've cleared my 2, I can move my stop loss. Most of the time, this will be in your 8 pip range. And so we should allow enough pullback to clear the wave 2 and be off and good. Yeah, stop profit. All right, so we've figured out whether it's an up channel or down channel. We know which one is going to give us the best success. We've calculated the number of lots we're going to put into the trade. We enter on 2 pips of pullback. We have an MSL set. We have an ESL set. We're going to make a decision as to which one of these we prefer to do, and I just say pick one and run with it for a long time. We know how to set our stop loss into break-even status. The only thing left is to establish your money management, and that is where you're going to hide your stops. No. Yeah, break even plus 1. When you gain 8 pips on the chart, not your trading station. 8 pips from the fork boundary. I don't care when you entered the trade, and I don't care if your spread's half a pip or 5 pips. We don't trade stations. We trade only from the charts. The trade station, the pips, the money will work itself out over time. Trust me. It also decomplicates what you're trying to do. Kiss it, kiss it, kiss it, right? So, money management. Think about this. I've got a fork, and it's fairly wide. Say this is a 60-minute scan. Well, no, let's just say we have a 60-minute, we're putting a fork on a 60-minute chart. Some of you are going to want to do that. I prefer 30. And later on you'll understand why. So if you want to start getting ahead of the game of where we're headed, do your trading off 30-minute charts for 60-minute forks. I'm not too worried about daily forks. I'm not too worried about 240 forks. I would say find some success with your 15s and 60s, and then later on you can consider the daily and the 240. But let's get some success down here. All right. I'm drawing them on my 30-minute chart. I've got a fork, and this is a pretty wide channel. What would be a wide channel on a 30-minute fork? Oh, 150 pips. Which means these half channels are what? 75. Which means, think about it. 25, 50, 75. If I have a smaller fork, maybe the whole thing's only 80 pips wide. Half channels are now 40 pips wide. Maybe I just go with my Fibonacci's. You know, again, maybe I select the 62 and the 38. And now these are places where, as price moves, 8 pips, my stop loss comes up from break even plus 1, or from minus 10 to break even plus 1. So this trade has solidified profit because it's break even plus 1. Price continues to move up, crosses my first barrier. Okay, that's cool. Crosses my second barrier. Now I'm going to move my stop loss from break even plus 1 to just under my second barrier. Price starts getting up here. It's about halfway between this last Fibonacci And the median, I can now move my stop loss up to this Fibonacci. Guys, do not worry about the times things don't go the way we'd like. Most of what I do is designed to be between an 80 and 85% winning system. And that doesn't mean we lose 15 to 20% of the time. See, that's old paradigm thinking. Remember, our stops are tight. And you can't really call minus 3.2 on a trading station a loss. Not when, in the old paradigm, we call 150 pips a loss. Once again, this is a mental struggle. How many? I got to go 150 pips to be back in break even. Here I'm 3.2 pips, I'm back at break even. We call this slush. And in terms of what we do, at the end of the month, you're going to have minus 3.2, plus 4, minus 3.7, 4.8. These are all in the old paradigm because of a negative in front of it. You would call it a loss. We call that slush because that's what it is. And as you proceed with your trading skills, this slush balances itself out. The plus 4s end up eradicating the minus 3.2s. You'll have more positives than you do negatives as your skill gets up there. What we're left with then are only the wins. Because these are MSLs. Our ESL is there only if we lack discipline in the MSL or we decided to try and trade during non-farm payroll or FOMC. The tighter your range, but you can't make them too small because then, we went over that last week. There's no, they're small enough. 30-minute below, they're small enough that you can do what you need to do. So, we don't deal with losses. The old paradigm, that's the first thing. I get new people send me emails all the time for some stuff I do. Well, what's your win-loss percentage? Because that's how the old paradigm thinks. When you think about that, if somebody says, well, I've got a 70% system, in reality, what that means is they win 70% of the time, but you have to take out the 30% of the time they lose. And what are you left with? 40%, essentially, when you do the math on wins versus losses. In the new paradigm, we don't have that. How do you compare a whole bunch of minus 3s and 4s that become net neutral at the end of the month? And if we don't have any stop outs, no minus 10s because we had discipline and took ourselves out at the MSL, you have 0 losses. Told you this was a low risk, high yield system. So you have all this slush that ends up being somewhere between negative and slightly positive at the end of the month, and then you have your wins. Oh, I got 15 pips. Oh, I got 11 pips. Oh, I got 4 pips. Oh, I got 37 pips. Against what? Our slush went net neutral at the end of the month. We didn't have any minus 10s because we use an MSL, not the ESL. Well, here's the thing. That's why we make our systems as robotic as could be. See, if you have to guess, if you have to bring emotion into your trading and you got to make decisions, should I get out here or should I stay in? If you have a line that says if price touches that line and you can't exit, I'm probably not going to be able to help you. What creates lack of discipline is when you have to make choices as a trader. When you're trying to make decisions, because when you try and make decisions, you invite emotion and ego, and as I've said many times now, emotion and ego are the worst trading partners you can ever have. All right, let me go back to the slide. So we've covered everything. Now, Fibo at 40% is another exit mechanism that you can use anytime. And what it counts on is if you've already had some progression in the trade. Think about these waves as they move on. Let me go back and kind of reiterate Elliott wave for a second. When we move up, wave 1, wave 2, and now we're on our wave 3, we said, oh, this was 50 to 61.8 most of the time. Wave 4 is not deep and quick like wave 2. Wave 4 is shallow and elongated. So if you're drawing a typical, what really should look like Elliott wave, it's going to look like that. Very hard to trade because these are typically complex corrections. It could be one correction tacked onto another, onto another, onto another, onto another, and it's really super hard in traditional trading, especially naked trading, to try and figure out where these end. Your typical wave 4 has its majority of pullbacks in the 70 plus range between 38 and 50. So notice it's not quite as deep as the wave 2, which is 50 to 61.8. But that 38 to 50 is what? That is the 2 to 3 move. That's a Fibo from 2 to 3. It's at 38 to 50. If it's at 38 to 50, even if it comes down to 50, what is that in terms of the wave 1? It's very rarely going to go below 40%. For those of you who can really understand Elliott wave and track Elliott wave, the reality is the wave 4 cannot go below, well, it actually can. In stocks, it can't go below the top of wave 1. In the Forex, it's allowed to come 17% down. So what I do immediately, as I'm getting way up in here, is I do a Fibo on wave 1 at 83%. That's the 17% pullback. I draw a line across my chart. My wave 4 cannot come below that. If it does, this structure is all blown out and I better be out of the trade anyway. In Pitchfork, there's no set MSL. It's a line. There's no number for it. It's when price hits it, you close all positions. There's no number to put in your trading station. Trading station can only hold one number. And that's where our emergency stop loss goes. Your MSL is a line on the chart that sits outside of the parallel, as I've explained like 10 times tonight. I know. So the bottom line is one of the money managements you can use once the trade completes its first pullback. So we have a move up, we have a pullback, and now it's taken off again. I can use this 40% because typically if price falls below that, I'm out of the trade. So what would that look like? Let's talk about a pitchfork. Well, I'm just going to bring up a scan, but it doesn't matter. I'm trying to keep this simplistic, so if you are just on the web scanner, you can do it there. If you have a pitchfork drawn or a scan trader drawn. See, the scan already has a money management system plugged into it. It has 3 targets. 1, 2, 3. And I'll tell you what I would do when there's 3 targets. I would trade 4 units. So if I had 20 pips or 20 lots I can put into the trade, I have a unit of 5, a unit of 5, a unit of 5, and a unit of 5. And I will take out my first 5 after we cross this and I have some pullback. I'm going to take out my second 5 after we cross this and I have some pullback. I will take out my third 5 if it makes it down here and it pulls back. That leaves me 1 unit of 5 yet. I still have 25% of my lots left. Yep, because this thing may go deeper. This is where especially I would use 40%. So let me show you how the 40% works. It's pretty simple. Let's say we had an entry here at D. Pretty big move. Oh, that's just, you love that. Break even +1, you're past your first target. See, this is a good example of what I was talking about earlier. There is no reason to exit any lots especially here because it gapped. So here we are, and then the next thing's down here. Well, actually, next thing's down here. Next candle's down here. We actually gone past the second one. So as we move up past the second target, I take out lots number 1 and lots number 2. But let's talk about this 40%. So all I do is build a Fibo that trails by 40%. And once I have my first decent pullback, and this is maybe not the best of examples because this pullback is a little terrible, but once I have this pullback here, as price starts moving back down, I can now use this. And all it is a Fibo with 40% retracement in it. And what I would do is I'd take this Fibo and I just put the top, I'd set the top right on that line. If you want to use the magnet tool over here, those of you not familiar with the magnet tool, there's a magnet tool. It'll set that line right on top of that wick, right where it belongs. And then the bottom of this, I just keep moving down with my price. Wherever price goes. So at this point, the max move down, I'll stay in that trade until it comes all the way back. And here it would have kept me in the trade. So it's very simple. It's easy to use. As soon as I enter the trade, I can come in here and put my top there, and now all I have to do is swing this over. As price moves down, just swing this wherever I want, and I've got my stop loss at the 40% level. Real easy to do. The law of association holds the home to all math. You can leg down this whole thing with twin trading. I mean, my lord, all it is saying I'm going to use 50% one way and 50% another way. Why not triple trade, quadruple trade? I mean, it's kind of a anyway. I know some people use it. That's okay. It's easier to manage one set of trades. And not only that, Jaron, where do you live? Okay, you're cool. For traders in the U.S. that have U.S. brokers, see, we're restricted to FIFO. Which means if I put in 2 trades and I try and take out some lots, it's going to take them out of the first trade. We can't randomly select which trade we want to remove. Same pair, of course. Hey guys, I want to say this. At the very first session, and of course that's already scrolled off, so if you're newer, I'll just repeat this. Because, I don't want to be harsh, I don't want to be mean, but I'm going to tell you why there's a 95% failure rate. And it's because nope, not the one I wanted, my bad. Well, lordy, lordy. I must be having a little mental breakdown here because I'm looking for a slide that I'm pretty sure I covered, and now I can't find it. So that's kind of interesting. I'll have to dig it out because I want to put it up next session. But there's a reality about what it takes to be a successful trader. And what it takes to be a successful trader is a number of qualities, including being an entrepreneur, being a little bit MacGyver, being a little bit adventurous, being a little bit, right attitude. Nothing's going to stop me. I'll find a way. That's kind of like the MacGyver part. You got to be a little bit, you got to be able to do simple math. You should have spreadsheet skills. You've got to put yourself in the position of, if I have a big dream, I am the only one that can stop me from getting there. Which means you have to be resourceful. And I'll say this, I'll just make it simple. YouTube is the world's second largest search engine. How do I draw a trend line on TradingView? Go put it in YouTube and somebody's got it answered. How do I put an alert on a trend line in TradingView? YouTube will have an answer. How do I clear my cookies? YouTube will have an answer. Step up, be accountable for your success. Stop looking for the world to hand it to you. Let the world hand you the stuff that isn't on YouTube, that isn't in Google. Things like how to trade in the new paradigm. The only place you're going to get that is here. So if you want to see visually something that needs to be done, so you need to see where's the button, where's the click, where's this, where's that, YouTube. Everything else that's step by step you can get on Google too. Use your search engines. Be resourceful. Quit allowing third-party things external from you being your limitation. Oh man, Spiller got me all excited last night. If y'all didn't see Spiller last night, you got to get that recording. You got to see that. Now I know some of you are traders and you're not business builders, but it wasn't about, most of it was just about, what you are, and nothing's going to hold you back. And what do real achievers do? Be accountable to yourself. Oh, honey, I'm sorry. I failed at my dream because Tim didn't give me the answer. Screw Tim. Maybe he doesn't see your message. Maybe he doesn't get your email. Maybe he's sick for a day and he can't get anywhere. You find it yourself. Yeah, there's a good thing. Make it life relevant. Put some emphasis on it. Oh my God, if any of you have teenagers, I'm probably older than a lot of you, but you have teenagers, sometimes motivating them is really hard. Dallas, do me a favor. Can you do this for me? Oh, man, I got work and I'm pretty tired when I get off work and then I got school the next morning. I don't know, man. Dallas, it's important. I don't know, Dad. I'll give you $50. Really? Okay, I'll be home at 9:30. I'll do it then. And then just before he starts, I say, I'm not paying you $50, right? I just wanted to show you that you can do it. So you can push yourself beyond, as Zoe says, if it's life relevant, you'll find a way. That's why you got to be MacGyver. Tick tock, tick tock. The bomb's about to go off. 13 seconds. You don't just sit there and go, well, I don't know which which wire to cut. Okay, get blown up. Try something. Take action with urgency. Be accountable. Be accountable. I'm not trying to pick on anybody, so please don't think I am. All right, so somebody asked if we see the pitchfork on here. It's not, look, yeah, I'll draw him one. It doesn't matter. It's not about the pitch. Well, that's kind of funny. It's not about there being a pitchfork on here. I'm showing you money management for a trade entry. So let's just say there was a pitchfork on there. And you caught this hit at D. You have several money management options. If it's a scan, you've already got some money management built in. If it's, you can use that. The fork is generally going to be better money management if it sits on a scan. If the D is on the fork, your fork is generally going to be better money management. Why? Because the scan is just one little point. Not that it's not a super point, but it's one little point. My fork carries more understanding of what's going on. Because see, what the scan doesn't take in consideration is this channel. All the scan does is it measures it horizontally. Which is why when I get down to this third one, I don't necessarily want to exit all my lots. As it comes back and pulls back, fine. 1, 2, 3, I take my third set of lots out and I leave my fourth in just in case this thing comes down here. And once it starts bouncing 2 pips up, exit the lots in my sell, enter my new lots in my buy. See, there's no buy. Once this fork is done its sell, it's done. Excuse me, once this scan has committed to its D and the D is run past 100%, that trade is over. Well, we'll catch more forks with this. We'll catch more pips with this. We'll catch more pips with our fork. So, money management. We had used the Fibonacci's and a pitchfork. We can use the targets from a scan if the scan is involved in the trade. We can use the 40%. Once we have our first pullback, we can use our flexible dynamic 40% exit line. And you just trade it the same way every time. Don't worry about the times your money management left money on the table. Trade it the same way every time. Old paradigm, too much emphasis on, oh, I left this, I left that behind, wah, wah, wah. Look, I'd rather go out and get a second, third trade while you're still crying over how to optimize your first one that you felt you should have made more pips on. That's how you create emotion in your trading. If you have a system that can be traded like a robot, trade it like the robot. I'm going to go back to this one more time. Move that over there. And go back to our chart here and make sure everybody has a screenshot of that. It was in the last session. And if you don't know how to read it, it was in the last session. That recording is still going to be available for another 4 more sessions. So another 2 weeks, that'll still be there. Well, week and a half. Got plenty of time to go back that last session and see the explanation for this. So now we've kind of covered it all. We talked about how to draw forks, how to draw them correctly, which way to point them. We talked about a good fork that's proven. We talked about where to put our stop loss for the various size forks. Whether they're narrow forks or wider forks, whether they're breached forks or proven forks with sliders. If we're outside the fork but we're hitting warning lines, we know what warning lines are. And then we know now the final part. Remember to trade buys on bottom, sells on tops unless it's an extreme situation. You know how you've got trade calc. Look how far you guys have come in 3 or 4 weeks. Pretty far. This is real decent coverage. I mean, people that have been around me a long time. Tim, Zoe. I didn't see. I think Theo's here tonight. I think I saw him earlier, maybe. Guys have been around me a long time know that to get this far that we've gotten in 3 to 4 weeks is pretty amazing. So you've come this far. It's worth the investment now. Now, guess what? Now, Steve says you can do demo trades. And now our mission is what? It's not about what you get in a trade. It's about the mistakes you make that we correct so you start eliminating them. And for those of you that don't have, I'll say courage to post trades, you're probably never going to make it as a trader. Because that's ego step number 1 of 50 steps. Not worrying about being embarrassed. So, post trades per this system. The admins know this system now. They have something to go by as a guide. You have something to go by. I want to make one concluding comment here. See, okay, something else I want to comment on here, and not picking on anybody again, but let me give you an example. I'm trying to do something in Excel, and it doesn't work, so I call Bill Gates, and I say, hey, Bill, I can't get Excel to work. Or I send Bill Gates an email, i.e. I send Microsoft technical support an email. I can't get Excel to work. That's not going to help them. They can't identify your problem. Hey guys, I'm having some trouble with Excel. This is what I was doing. This is what a screenshot of what I got back. Or here's the error message that I got. Okay, that'll help you. It's really hard for us to help when you say something like, I can't get into the Pitchfork course. I don't know what that means. Did the URL not work? Did you get to the URL and register, but you never got your confirmation? Did you get to the URL, register, got the confirmation, but somehow your password didn't work? I don't know what it means. I can't help you. And I'll tell you this, quite frankly, I'm averaging about 300 Facebook messages a day. If you're getting a 401 error, it's probably because there's a whole bunch of other crap added to the URL. So all you have to do is look at the URL that you're supposed to enter, and if the URL that appears in your browser is different than that, take out the crap that was added. That's like 90% of the 404 errors. There are times, Tim, where it's putting some extra characters after that. I'm not going to shoot anybody. I just need you to be more accountable. Help me, help Tim, help Zoe, help, Adam and Theo and Stephen. Help us help you. Because you're not the only person we're helping. And when we have to pull it out from you like pulling teeth, what were you doing? What didn't work? Give me a screenshot. Let me see. So we can give you an exact answer and you can be on your way. We don't need to drag it out with 5, 6, 12 hours in between question and my response, and my response creates a question for you to answer. Oh my Lord, come on, let's speed it up. Let me help you. All right, final comments here. And this is the difference between the old paradigm and the new paradigm. In the old paradigm, you were used to setups. And in fact, you might have had somebody say, let's look at a 4-hour chart. And here comes price. Blah, blah, blah. And that person would come along and say, well, it looks like we have some support and resistance here. If it's nice to the pip touches, we might get by with a line. Sometimes it might be a zone. Oh, look at this. I've got support on both sides. I've got, support here and resistance there. That makes that a strong line. Oh, look at this. There was a double bottom. That's a pretty strong line. Here's the trouble with that. That is on a 4-hour chart. In this last move from S to T, just giving them random designators, if this is a 4-hour chart, there were plenty of 30-minute moves that were true 30-minute swings. Meaning, those were trades. The 4-hour trader doesn't see those support and resistance points because they're only looking at the 4-hour level swings. So if you're trading a scan, these support, that's 30 minutes, or that's 60 minutes, these 4-hour support and resistance points are only valid at the 4-hour, level. There's plenty of swings inside that we can trade. And in fact, if I plot my 60-minute scan inside of some of these 4-hour moves, we'll see that's exactly what we have. So we have to have something to discern this, to help us navigate smaller time frames, because the larger time frame support and resistance as terms of entries and exits and retracements is only valid in terms of the 4-hour. So we've got to have mechanisms for that. Back to our chart. We now know everything we have. You're empowered to do demo trades in the group. No whining. Take the trade. Let us correct it. You're not going to win 100% of the trades, but the ones you lose are going to be so small as long as you follow our system. Now, as I was saying, post your trades. If you're afraid to post trades, you're not going to make it as a trader. As I said, that's step one of ego resolution. Second thing is, you're not going to see your own mistakes. That's an RAS trick. You need expert eyes to see this. All right, so let me get back to that last comment to conclude on. Don't expect a pitchfork to be the same. And the problem I did was I erased what I had there. So, what we had was support and resistance lines on a 4-hour chart. And what you'll see some traders do is, oh, there was a move. It came back and tested that. It did that. It comes down like this, and it's right here. And it comes through. And right here, it starts moving up. And so you'll see somebody do something like dot, 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 right? That's technically a forecast. And I know what that means. It means there are actually some traders that are putting entry orders on that bounce when price is here. I.e., these support and resistance lines become trade entries. 4-hour moves. We don't forecast trades. If I put a fork on my chart, now listen to this and we're going to end. If I have a if I have a 60-minute pitchfork or a 30-minute pitchfork on my chart, there is no forecast in that. It is a trap. We know from down here, there is an expectation with 80% odds we're going to get to the median. It doesn't mean this thing can't fail and come down. And if you have this pitchfork on your chart and that trade never takes place, you are not a bad pitchfork drawer. You are not a bad trader. You didn't make a wrong forecast. The pitchfork makes the decisions for you. We're waiting for the interaction between price and the pitchfork. It's a trap. If price doesn't get trapped, it's not an incorrect fork. It just didn't hit this time. Go draw another fork. Some of you have drawn your traditional fork perfectly. I have a swing high. I got a swing low, and I come back to my previous swing low. And you post that fork, and you say this. Is that a correct fork? It's got two answers. One, per the structure and the direction you have the fork pointing, that is correct for a traditional pitchfork. It says nothing about this pitchfork giving any trades. The trade is there when price hits our line and we have the bounce. No trade, no trade, no trade, no trade. No trade down here. Price goes through it. It doesn't bounce. It comes back and checks the median. Well, there's an Andrews observation. 2 pips, I'm in the trade and we're off and running. Nobody's saying that's where it's going to get. Andrew says a lot of the times it will. We have money management. We're just going to take advantage of this bounce and get as many pips out of this as we can. As time moves on and price moves eastern, if there aren't hits with our traditional fork, we can move it up and down, move the median up and down, and see if any of these price points give us a good best fit hit. And maybe we have that set right here. And then we go 2 or 3 more days, and we have something that's a little short here. So we adjust the fork again. It doesn't mean it was wrong here. We actually got trades off of it here. But if there's better touches to be had down here, I will move the fork to give me those touches. It's about pips, guys. There's nothing about predicting rightness. You have to get it out of your head. You are doing everything you can to catch the trap. If I have a bear trap, I mean, not that I'm, want to be cruel to bears, but let's just talk about my bear trap. If I have a bear trap, there's a tree in my yard, and I set my bear trap here, and every day, I look out in the morning, and the bear and he walks just like that. The next day, and the next day, You know what I'm doing? I'm moving my trap from there to there. So you're absolutely correct, Pitchfork. Don't sit there and stare at it 4 days waiting for a trade. You may get some. Take them if you do. If you don't, look at the touches on the fork and say, I'm readjusting it. Hope that makes sense. All right, we got to get out of here. Hope you guys got something of value tonight. Oh, yeah. Oh, look. Tell you what I'm going to do. I'm going to tease you. Who wants to be teased? Who wants to be teased? Anybody want to be teased? Do. I don't know if I could do it. No, I didn't mean to do that. That was a tease of the web analyzer. All right, y'all have a great night. I'll see you Wednesday. See some demo trades. Let's go. Demo trade. Ding, 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 ding. You can do them now.